What happens when Wall Street fights the Fed? Let's dive right into this. On a seemingly ordinary Tuesday, a lackluster inflation reading sent U.S. stocks spiraling downwards, just a day after markets reached new all-time highs. This sudden swing in fortunes underscores a significant mismatch between the expectations of policymakers and investors regarding interest rate cuts in 2024. Federal Reserve officials, including Chair Jerome Powell, have repeatedly expressed their vision of a maximum of 3 rate cuts in the year. Wall Street, on the other hand, has chosen to turn a deaf ear to these warnings, maintaining a steadfast optimism. Investors, brought down from their lofty dreams of 7 rate cuts in the coming year, were still expecting 4 to 5 cuts as of Monday. This mismatch between the policymakers and Wall Street led to the worst market day since March 2023. The drop in the market is partially the result of a great reckoning for traders. This sudden turbulence serves as a stark reminder of a lesson Wall Street has been taught before: don't fight the Fed. The pace of price hikes in January cooled off a bit, but not as much as expected. The first measure of inflation for 2024, the Consumer Price Index, shows prices rising by 3.1% for the 12 months ending in January. This is a step back from December's 3.4% rate, and a significant slowdown from the 6.4% increase seen in January 2023. The U.S. Treasury yields reacted to this report with a surge. The 2- and 10-year Treasury yields rose to 4.6% and 4.3% respectively. This increase in Treasury yields could spell more bad news for stocks. But remember, one bad day does not a market downturn make. The stark reality that the Fed can still not declare victory on its long campaign to quell inflation was a hard pill to swallow. The market had to grapple with the fact that, despite a series of rate cuts, the Fed's power to control inflation remains undeniably real and unpredictable. The market's performance has been a roller coaster ride, with investors' optimism tested by the sudden volatility. Yet it's important to remember that volatility is not synonymous with doom. It's a sign of a dynamic market, one that reflects a myriad of factors beyond just the Fed's actions. Amidst this turbulence, investors have shown resilience, continuing to play the market and seek opportunities. The S&P 500, a benchmark of American stock market performance, is proof positive of this resilience. Despite the turbulence, the S&P 500 is still up by more than 3.8% so far this year. Markets clearly don't often take kindly to higher for longer interest rates, but is this what the Fed wants? This question might seem perplexing, yet the answer lies in the Fed's underlying strategy. You see, when markets tumble on the news of inflation, it's not necessarily a bad thing in the eyes of the Federal Reserve. In fact, it sends a clear message to the market participants, underlining the seriousness of the Fed's commitment to getting inflation rates back down to their long-term goal of 2%. Moreover, there's a fascinating correlation between rising stock prices and housing activity. When stock prices surge, it often leads to stronger housing activity, which in turn stokes inflation rates. This might seem like a paradox, but in the intricate world of economics, one action often triggers a chain reaction of events. In conclusion, while a market downturn might seem like bad news for investors, it could be exactly what the Fed wants. It's important to remember, don't fight the Fed.